and we like, and let's put up on my screen here. And so SEP and simple IRAs, we like to keep them in one category because they have a lot of things in common. The first one is they're very simple to set up. They don't require any IRS filings. They require a one-page document to set it up. And since you're not filing with the government on an annual basis, that has very low administrative costs. So for startup plans, these two are usually your best options, unless we'll get into later, unless you're really trying to max out over the next, 3 to 7 years too. Also, it allows a lot of flexibility for the employer, the company, to make contributions on an annual basis. They're not required to make contributions on years, or maybe they can't afford it too. So we're going to get into a little bit some of the rules, and then at the end of this section, I'll give you a few examples of what are the right types of plans that we've seen for businesses. But for some of the eligibility rules, any company can set up a SEP IRA accounts for their employees. There's no restriction on business size or structure. Simple IRAs, there are a few rules. You can't have more than 100 employees that earn more than $5,000 on an annual basis. So I'm not sure if a lot of people will run into that, but that is a consideration for some. And with both of these type of plans, you can't have another retirement plan along with one of these. You can't have a 401k and a simple IRA account for the same company. Like I said, simplicity is one of the reasons why a lot of people like these plans. There's a one-page adoption agreement to set it up. Some of the eligibility requirements to walk you through, but really the idea of the eligibility requirements is that the goal is to only give benefits to employees that are going to stay with you for a longer period of time. These plans wouldn't work if you gave someone retirement benefits and then they leave a year later. So the goal is to benefit those that you plan on foreseeing sticking with you for a long time. So some rules with the SEP IRA is you can exclude anyone under the age of 21. Anyone that earned less than $650 this year, which is a very low number. We'll get into that later a little bit. And employees that haven't been employed with the company 3 of the last 5 years. So, if you have an employee that's worked less than 2 years, you're able to exclude them. Or if they worked, 4 years ago and then they just started working again, you wouldn't have to include them for this calendar year too. Simple IRA eligibility requirements is you can exclude anyone that has earned less than $5,000 the previous 2 years and is also expecting to earn $5,000 this year. So basically they look at this calendar year and the last 2 years, and if they were part-time and didn't earn a lot of money, or if they've only worked there for a year, you're able to exclude those individuals too. Right, the whole idea again is to benefit those people that you plan on sticking with you for a long period of time to help grow your business. Setting up these accounts is really easy. You just set up an IRA account for each person, each participant, and you can do that at your local bank, I'm sure, or you can do it with a wealth management team, and you can do it pretty much anywhere these days too. Reporting requirements are very limited. You don't have to report with the IRS, but you do have to let all of your employees know that it is available on an annual basis too. Fees are basically just paying whatever fees you have set up for opening up the IRA accounts, but there's no annual reporting fees with that too. All right, so the IRA contributions for a SEP IRA, they're very flexible. It's all employer contributions. So individual employees aren't putting money away out of their paycheck each month. The employer is making 100% of the contributions, and it can vary from year to year. So say you have a really good year, you can make contributions, but the following year is not so good. You're not required to make contributions on an annual basis. So that gives a lot of people flexibility if they have cash flow that varies differently from year to year. And so the maximum you can contribute for this year is 25% of compensation up to $290,000. What that means is the 290,000. So say if you make $500,000, you're only able to do 25% of $290,000. Obviously, if you earn less than that, then you can do 25% of $150,000 or whatever your income is as an employer business deductible expense. So it's the lesser of the 25% or $58,000 still. It's the lesser of those two amounts is the maximum you can do. Yeah, SEPs are really good for small businesses. We have a few machine shops where it's a husband and wife, and their goal is to have a simple plan that they can contribute to every year. And since they're the only two employees, they don't have to worry about contributing to part-time employees. They get 100% of the benefits too. A lot of people, some other shops, they like it too because they really rely on one or two other people. So they're okay giving them those extra benefits too. But really we see it a lot for family businesses, two spouse and maybe a child. And like I said earlier, it's ideal for companies with volatile profits, for painters or certain contractors that are, their yearly earnings are different every year. It's good for those type of companies because you're not required to make contributions. Like I said, if you contribute to one person, you got to contribute to everyone. And that includes anyone making over $650 this year. So that includes part-time employees. And you can also exclude employees covered by a union agreement if the retirement benefits are bargained for in good faith by you and the employees union. So, we set one up for an insulation company where everybody was unionized except for the owner and her key employees. So those are where we've seen SEP IRAs work, and also self-employed individuals. Sometimes it works well for an attorney or a CPA that works for themselves too, if they want something cheaper than your traditional 401k plan. All right, next we have simple IRAs. Simple IRAs work just like a 401k, but they're simple. They're a lot cheaper. You don't have to do annual testing with the government, but the contribution amounts are a little less. So this year you can contribute $13,500. If you're over the age of 60, you can do an extra $3,000. And it works like a 401k where there's an matching employer contribution. It can be up to 3% of compensation or a non-matching 2%, which means you basically give everybody 2%. And even if they don't want to contribute, we typically don't see that because employers and owners want to see that their employees have some skin in the game, that they're also contributing to their retirement too. Usually they're best suited for small companies that are just trying to set up a startup plan and they still want to encourage new employees there. They're still looking to grow, but they don't want the robustness of a 401k plan. It allows the employees to save for retirement. There's very little administrative cost, so you don't have to file with the government at $5,500. So very cheap, basically the cost of owning an account, an IRA account, wherever you have it. And like I said, the employees and the employers are sharing the responsibilities of saving for retirement too. You have some skin in the game, and people are in charge of their own destiny a little bit and saving for themselves. A lot of times we have simple IRA accounts for small businesses. And then as the owner gets older or as they decide that they want to start saving more, we look and transition to more of a 401k option too. But it's a good start for someone that just wants to start saving and work from there. And as things change, there's obviously opportunities to change plans too. All right, SEPs and simples, the distributions are same as a regular traditional IRA account. Employees can take withdrawals at any time. They're subject to penalties if they're not over the age of 59 and a half. And whenever you take money out, you're taxed at ordinary income. So the whole goal is you take it out in retirement when you're making less income than you are today too. And like an IRA account, there's mandatory distributions that start at the age of 70 and a half. They recently changed that to 72 if you were born after June 30th of 1949. Next, we're going to look at defined contribution plans. So this is your traditional 401k, your profit sharing plans. And like I said, you're defining the contribution. The employees are in charge of making contributions for their retirement too. So traditional 401ks, you're putting pre-tax dollars and it grows tax-free. And then when you take it out in retirement, it's taxed as ordinary income. So 401ks, there's a lot of flexibility. You can set it up any number of ways. Typically, there's both employer and employee contributions. You don't have to have employer contributions. You can just have it available for employees if you want and have no match. There's no business size limitation. The biggest companies in Mass all have 401ks, like General Electric or any of the universities. They're all going to have 401ks in place. Some other features, you can have vesting schedules where the employer match is not fully guaranteed to the employee unless they work there a certain amount of years too. So we can get into that another time. But there's different schedules where you can say, hey, we want to make sure that our employees stay here for 5 years, so we're not going to fully match it until 5 years from now too. And then you can make it eligible for part-time employees if you want to benefit them as well. And you're also able to take loans from these accounts too. Typically, people would do that for a first-time home purchase or whatnot. Obviously, we wouldn't encourage someone to take from their retirement account, but a house is also pretty important too. So again, with the flexibility of the 401k, employees for under the age of 50 can contribute up to $19,500 for this year. If you're over the age of 50, you can contribute another $6,500 for a total of $26,000. On the employer side, you can contribute up to 25% of the compensation. And again, like the SEP IRAs, that's limited at $290,000. So if you make $500,000, you can do up to 25% of $290,000. And then all in, the most you can contribute to for this year is 100% of your compensation, or $58,000. And that's $64,500 if you're over the age of 50. So, if an employee only makes $20,000, the most that they can contribute is $20,000 to a plan. But that would be 100% of compensation. All right, let's get into Roths a little bit here. A lot of people ask about Roth 401ks. What's better? From what I've read, a lot of the IRS looked at Roths when they set it up originally with a 10-year time horizon. And at 10 years, Roths and regular IRAs will generate the same amount of tax revenue for them. So if you don't need this money for more than 10 years, it's usually more advantageous to do the Roth 401k. And also, if you plan on gifting this to children or the next generation, Roths are more advantageous for you than a traditional IRA for gifting purposes too, if you're just trying to reduce your tax liability and that's your goal for this account. So, basically it works, you're taxed today, but you're never taxed again on it unless you take it too early but that's the goal. And it works like a Roth IRA, but there's no income restrictions where, anyone can contribute to a Roth 401k through work. And but you do have to take the mandatory distributions from a Roth 401k where you wouldn't have to do that with the Roth IRA too. So 401k, some considerations is they do discrimination testing, which means that they have to do specific tests so that all the benefits don't just benefit the key employees and the owners. They have to benefit everyone somewhat equally too. So there's a number of tests that are run for 401ks to make sure that they meet these requirements. And one way to avoid the testing is with the safe harbor 401k, where basically the government said, hey, these are the rules. If you do matching contributions 100% up to the first 3%, and then a 50% match between 4 and 5% of an employee match, we don't have to do the testing. So if an employee wants to contribute 3%, the company would have to match 3%. And if they want to contribute 5%, you're only doing 50% match between 4 and 5. So employee contributes 5%, the company only has to contribute 4% too. And if they contribute 7%, the company only has to contribute 4%. There's also non-elective contributions where you basically give 3% to everyone, regardless if they want to contribute to retirement or not. Again, I haven't seen the non-elective contributions before, because the whole idea is to have skin in the game. And then you have, the safe harbor, you have additional things you can add on to it. If you do automatic enrollment, it eliminates a lot of the testing that makes them more expensive. And these numbers are from 2019, but I think it shows a good graph on how much you can contribute when you compare the SEPs, the simples, and an individual 401k for, a lawyer, an attorney, or whoever, someone that works for themselves. So the numbers are from 2019, but the graph stays the same, where if you look at the blue area, the simple IRA, it's pretty flat in how much you can benefit from contributing. The SEP, it goes up pretty equally with the traditional 401k, but obviously the traditional 401k, you're able to contribute a lot more than you would the other two plans. So it's more expensive, but if your goal is to put more money away, then, it might make sense to use that and, have a 401k instead of a SEP IRA. Yeah, like I said, you have to file with the IRS the Form 5500 on an annual basis, which makes it more costly. And there's increased costs for managing a 401k, and there's fiduciary responsibilities. So the key employees are all responsible for the investment options in a 401k. Typically, we meet with our 401k plans once or twice a year to go over the options. You usually need to have 3 different types of options available. One more of a long-term growth. You need a more conservative investment, and then you need a cash option available. A 401k wouldn't work if people weren't able to choose what type of investments are right for them. And other responsibilities are providing, education for the employees on an annual basis to let them know that it's available and what the different options are too. So that's become more of a thing recently, the fiduciary responsibilities for the key executives and the owners, and educating the employees and making sure the investments are up to date on a regular basis too. Yeah, withdrawals are subject to, ordinary income. When you're in retirement, you pay taxes on it as income. If you take it too early, you're going to pay a 10% premature penalty. And like I said, for regular 401ks, you have to take distributions starting at the age of 72. Yeah, lastly, we have defined benefit plans. So this is your more traditional pension plan. And, it works really well for individuals that are 40 or older that say, hey, my goal with this business is to fund my retirement. We don't see it as much anymore, because you have to commit so much money to guarantee someone income for the rest of their lives. We have third-party people come in and say, hey, you need X amount of dollars to make sure, Joe is able to live the rest of his life, and you're not going to run out of money doing that. It worked really well, 20, 30 years ago when interest rates were higher. Back in the 80s, early 80s, interest rates were 12%. Like, if you can guarantee a treasury bond at 12%, it's a lot easier to say, hey, we can make sure this person can retire based on our investments. And, even in the early 2000s, treasury bonds are about 5%. So that made it a lot easier for companies to fund defined benefit plans. And now with interest rates so low, you almost never really see them today unless they were grandfathered in from a long time ago. So it sounds really good, but the amount of money that you need to fund it is just really tough to be at right now. But you can exclude certain employees, just like other plans, where people younger than the age of 21, people that work fewer than 1,000 hours a week, or they've worked there for less than 2 years, or if they're covered by the collective bargaining agreement too. So like I said, they're much more complex to administer. It requires an actuary to come in and say, and figure out how much money you need today to make sure all of your employees have income guaranteed for the rest of their lives. And all the assets are in one big account. You don't have like your own IRA account or your own 401k account. And there are no employee contributions either. And there's, it's very high cost, and it's very fixed and what you can guarantee and what you can expect to receive for income too. So this is my contact information. If you have questions, give me a call, shoot me an email. If you're comfortable getting a cup of coffee somewhere, we love that opportunity. And there's our website. So I appreciate being here. I appreciate you all coming to listen. So I'll turn it back to Teresa now and see if there's any questions.
I do see one question. Hopefully a few more will be added while you're answering this one. Someone is asking, best option for independent contractor?
It depends on what your income is. I mean, the SEPs are really easy. If you want to put a lot more money away, then probably an individual 401k plan. So it all depends on what your income is and how much you want to put away. Really, but those are probably your two best options.
Okay. I guess I'm not seeing any other questions. Give a few seconds here. Okay. Oh, somebody asked if the presentation will be shared. We will be posting the recording on our website, and you can catch that. I'll have that up there by tomorrow. I will throw that link up real quick again. Oops. There's the link where the recording will be available. Okay, well, I guess that's it then. I don't see any more questions. Oh, wait. I have LLC, and as an owner, I do not take a salary. Can I still have a simple IRA?
You would need to show income, and part of that's with your CPA. We work with a lot of LLCs. It's a little different. But yeah, as long as you show some kind of income, you can contribute to a retirement plan.
Okay. All right. I think then that concludes all the questions we have. I just want to thank you, David, for presenting all this great information for us today. And I guess everyone have a great day.
Yeah, thank you all. Feel free to reach out if you have any other questions too. Thank you, Teresa.
All right. Thanks. Bye.
Bye.